spike the low, they issue a hammer at M1 pivot. You get a shark fin and TDI. It happens to be level 3, just outside the blue box, right to yesterday's blue tracer at the low. This would be a confluence of things coming together. Understand? That's what I'm talking about. And these are the things over the next day and a half we're going to strip down and build back together so you can understand how to find these signals, the proper signals. All right? Just because the market makers make a small consolidation zone, do not mistake that for an M forming, Tony T. That is not an M or a W forming. You have to know where you are in the cycle and the proper timings and context. Yes, Peter, exactly. Multiple things came together on Euro CHF last night and issued you a perfect entry signal. Rob, it's up to you. If you see it right, it is. We'll talk about it. It's got to work for your personality. Okay, so what we're going to cover is the trend, evaluation, and count. I'm going to show you the difference between the market maker trend and the retail trader's trend. How to check down what to trade. Box is blown out, you pass. Certain behaviors, this pair's at level 2. Best time to enter the trade. I kind of told you already, but I'll cover it again, a little more spread out. You can't hang around and wait for something every time at 345. You might miss the move. And then the most important thing, how to manage it while it's on. That's what I'm going to cover over the next day and a half or so. Okay? The trend. Is everybody good? Okay, cool. Hey, Sean, I didn't see you there, buddy. Thank you, thank you. Paul, need some ribs from Back 8 Barbecue over there in Texas. Okay, good. All right. The trend. How do we identify the trend? We know there's two types of trends. There's the retail trader trend, what he wants you to see. There's the technical trend, what the rest of the world is looking at. The market makers perpetuate the technical trend and make you see it. They validate those signals on purpose. It's a dirty business, man, but that's what they do. The levels are visible on all time compressions, but I feel that they are visible on the 1 hour chart, highly visible. Some people like the 4 hour. Zaim happens to like the 1 hour. Carr likes the 1 hour. Some people can't decide, so they take the 15-minute and the 1 hour, cut it in half, and use a 30. I don't care. I want you to do what works for you. The point is not to fill my ego. The point is for you to see it. So don't use what I use unless you really and genuinely see it. I'm not going to be offended, man. I want you to get it. Okay. Keep this in mind. Hey, John, how you doing? The trend is set by the market maker and can be reversed at any time for no reason. The real reason for him to change the trend is because the dollars are getting out of whack and he needs to get them back. Understanding this, that it goes both ways, gives you a major edge. It allows you to stop thinking about the technicals and that, oh, in a downtrend, I'll only take rises and sell. It allows you to say, anytime it bottoms out, I'm not going to wait and buy. It allows you to take it down to the buy level and then back the other way. Don't get so caught up in your baggage or bias that you miss the good setups because you think it's supposed to go this way. Market maker hits the stops high, you're a seller. Market maker hits the stops low, you're a buyer. In line with peak formation, second day V, good stuff. Got it. Okay? If I'm going too fast, please let me know. This is important. This is how to establish the trend. Now, I like to think everything I say is important, but this is pretty important. Okay. The trend is generally set up as a 3-day cycle. Day 1, there can be multiple rises inside of day 1, but day 1 should be level 1 rise back into consolidation after the anchor point is formed. Okay? It's reversal day. Peak formation is formed, high or low. Second leg W, second leg M is formed. What's kind of cool about knowing what you know now is that day 1 comes as a market surprise. What do you mean? It catches all retail traders off guard. And then it's aggressive. Look what happened Sunday, Monday. 3 hits to the top, the trend was up. Just kidding, dropped the bottom out of it. This catches everyone following traditional indicators and trend following strategies off guard, retail traders. The news is used to perpetuate false trends. Okay, my D fell off. Thank you, Gloria, for my English lesson. If you're at, you see the anchor point W, right? And then it rises up and pulls back, and the next night there's news. They'll make a V bottom right around 3:30, and if the news comes out at 4:15, whatever it is, they will spike in the correct direction to continue on with the market maker trend. So that's why I told you in the presentation the news is crap. If they happen to have trapped lower level shorts when the news is released, they will rise price. It doesn't matter what the news says. The news might say, oh, the pound's weak, and then the pound will still rise. That is simply because they have to complete their targets in their cycle irregardless of the news or regardless of the news. Okay? Yes, the news is BS, man. I said it and it's true. The news is pure crap. No, I'm not saying not to pay attention to the news. You need to be out or flat on the red releases. I'll talk about that, but for argument's sake right now, don't say, oh, the news said that there's less jobs in the U.S., so dollar-based pairs will drop. That's not true. What's going to happen is, depending on where market makers are in the cycle, they will behave based on that and nothing else. Okay? If they're at peak formation high, they'll hit the stops high one more time when the news is released and then drop. That's how they do it, and that's why they do it. No other reason except for the money. That's why the news doesn't match up with the way the currencies move. That's exactly why, because it doesn't matter. Okay, day 2. Okay, so you have day 1, peak formation is formed, comes as a market surprise, reverses, right? Day 2, the moving averages on the higher time frames will signal. The 5200 on the 1-hour chart might cross over. Traditional indicators will cross over and fire a signal. Zero line MACD will cross. CCI might cross. RSI might cross the midline. Retail traders wait for confirmation and validation to enter the market, right? I can't think of who it was, but someone had a system where MACD crosses the zero line on the pullback. It has to take out the next bar. When it takes out the next bar, you enter the trade or some crap like that. That's called the validation of a signal. Retail traders wait for this. Waiting for this forces them to lose money. But here's what happens. If the traders aren't committing their funds, market makers aren't making any money. We all know they're in the business to make money. So by executing a move in such a way on day 2 that forces the moving average crossover, the indicators to cross the zero line, or certain indicators across the 50 line, it fires a signal. And to come back with a false move again towards the high or towards the low validates those signals. Understand? It's on purpose. That's why when you get a signal and it validates and you take it, it doesn't always work out. You were in the wrong segment of the market when the signal got validated. You were in stop hunt high, and you took it as an extension continuation because you had MACD confirmation It broke the previous swing high. That's why that shit doesn't work. That's where the pin comes in on the second leg and snatches you away and grabs your orders. Exactly. Market makers force the hands of the retail traders to get them to commit their money because, after all, objective number one is to get you to click the mouse. If that money sits there on deposit and doesn't get into open float, it's of no use to them. Ah, sneaky. I brought that all the way back from day one. Slide one. Understand? They know what they're doing, man. It's a big carnival. They validate the technicals on the chart. They show everybody the crossovers. They show everybody the zero line crosses. They validate the swing high with a spike, picks up the orders, right? Gets the breakout traders to fall, snags them. Bingo, got them. Okay. Day 3. Remember? 3 psychology. Traders are now convinced that this is the real move. Market makers show a thing called trend acceleration. That's when you get separation from the moving averages. The averages are fanned out. You get vector candles at level 3. The vector candles seem to be a monster amount of momentum entering into the market. Some people might even say, one of my pet peeves, risk appetite's in there. Hate that. Okay? You start getting vector candles on the last day of the cycle, and you also will see a 33 trade. Yes, Ziva, it does work. It does work or trades won't be around, but those are 50-60% systems. I mentioned earlier, the news is used to further the cause. Just when everybody sees it going a certain way and they get excited and want to take the trade, market makers hit the brakes and trap everyone except us the wrong way. Okay? Alright, so now we have a 3-day cycle. Day 1, peak formation high, is usually the end of a trend cycle. Catches everybody off guard. Market makers trap the higher level longs, lower level shorts, and snatch the market away from them. They come back, form out the M or W, which is our anchor point to go the opposite way. That move validates all the retail stuff that's out there. The news could help to trigger that. Could time it right at 4 o'clock or right at 8:30 U.S. time to get the news release to coincide with it. Day 2, the new trend is underway. Market makers must force the hand of the retail traders to commit the funds the opposite way they were previously going. How do they do this? They perpetuate moving average crossovers, zero line crosses, RSI 50 line crosses, CCI line crosses, whatever the indicator people are using. They force those to cross on the higher time frames. Most people trade multiple time frames. So the extended trend run forces all those charts to turn over. The 3rd day of the cycle, vector candles, acceleration towards the high. This also applies intraday, by the way. The vector candles, acceleration, pins turn to the top or bottom side. Pins turn to the opposite direction of where they're going to be going, or the current direction. If you start seeing pins issued to the top, pretty sure you're in level 3. Okay? If you see pins issued, pull back, again, pins issued, pull back, you're in level 3 of the cycle. Understand that. Market makers apply the brakes, trap everyone except us the wrong way. That's the 3-day cycle. Now this cycle in 3 moves also plays out intraday. Remember I showed you? Peak formation low, stop hunt, rise off of the low, hit the stops, rise. Hit the stops, rise. Hit the stops high. One direction, unidirectional stop hunt. Snatch the traders, pull away, validate the pendings, one more pass, pick up the breakouts, grab the guys that were in the right direction by stopping them out or scratching them out at +1, and then on their merry way the opposite direction. Okay, I'm going to draw this stuff for you.